and discontinued operations. Non-current assets held for sale and discontinued operations is a current asset. The standard is not applicable to inventory as the same is held in the ordinary course of business. The objective is not to sell in the ordinary course of business. Sale of building by DLF it is not applicable, but sale of building by Infosys it will be applicable. A sale of vehicles by Maruti it will not be applicable, but sale of vehicles by TCS it will be applicable. India's 163840 when the company decides to sell the assets it becomes NCA HFS non-current asset held for sale as current assets applies to recognized non-current assets or disposal groups. Disposal group example sale of factory could contain current and non-current assets. Classification as held for sale. If the future economic transaction is to be done through sale of the asset rather than use of the asset, then it is held for sale. Immediate sale in present condition. ISPC. Sale is highly probable. HP. Management is committed to sell the assets. RK Limited plans to sell the building, but will sell the building after 6 months. The same is not a NCA HFS as it is not immediate sale in present condition. ISPC is not met. If RK Limited plans to vacate the building within 7 days of the sale, then ISPC is met and it is NCA HFS. There should be ability to transfer the asset. If a court case is going on, then intent is there, but the ability to transfer the asset is not there. Hence, it is not an NCA-HFS. Sale is highly probable. Sale is highly probable when management is committed to sell the asset, active program to locate the buyer is initiated, price is reasonable, and sale will materialize within 1 year except outside entities' control. When asset is classified as held for sale, then depreciation would not be computed. An entity is committed to plan to sell the factory. The production cycle is 6 months, and the pollutants are involved. The company must meet its existing orders, dismantling the equipment and cleaning the polluting input would make the factory out of action for 6 months. Does this factory meet the criterion of immediate sale in a present condition? No, the factory would need several months to complete the order and cleaning the factory. It does not meet the criteria of immediate sale in present condition. An entity is committed to plan to sell its HQ and has initiated action to find the buyer. Situation 1. The entity intends to transfer the building to the buyer after it vacates the building. The time to vacate the building is normal. It is NCA-HFS as it is ISPC, immediate sale in present condition. Situation 2. The entity would continue to use the building until its new headquarters is built. The building will not be transferred until construction is completed. No, it is not NCA-HFS as ISPC is not met. Immediate sale in present condition is not met. Situation 3. An entity is committed to plan to sell the asset manufacturing facility and has initiated action to locate the buyer, but there is backlog of customer orders and the entity intends to sell the facility with its operations and any incomplete orders would be transferred to the buyer. Yes, it is NCHFS as ISPC is met. The entity intends to sell the facility but without its operation, and it does not intend to transfer until it clears the backlog of orders. It is not NCHFS as ISPC is not met. Exception to 1 year rule. An extension of the period beyond 1 year under circumstances beyond the control of the entity. Unexpected conditions imposed by the buyer or third party. Unexpected circumstances delayed the sale. Example, Noida registration not happening. This is beyond the control of the entity. In such circumstances, the same will not be classified as will be classified as NCHFS, and even if the ISPC is not met. Example, Vidyut Limited, an energy sector company, is committed to sell its one of its business lines. This requires regulatory approval. It could take more than 12 months to obtain the approval. However, a firm purchase commitment is signed before the approval is obtained. Answer: it is NCHFS as exception to 1 year rule. An entity is committed to sell a manufacturing facility, but after a firm purchase commitment is obtained, the buyer's inspection identifies environmental damage that must be made good, and this will extend beyond 1 year. However, the entity has initiated appropriate procedures to repair the environmental damage and the sale remains highly probable. It is NCAHFS exception to 1 year rule. Abandoned assets. If an asset is abandoned, it should be not be treated as NCHFS. Three machinery demand has fallen and two are abandoned. No, it will not be treated as NCHFS. Depreciation would be charged on the abandoned assets. How to compute NCHFS? Compute the carrying value as on the date of the classification of NCHFS. Cost less accumulated depreciation less accumulated impairment loss. On the date of reclassification, calculate fair value less cost to sell. Recognize NCA-HFS at lower of carrying value as per B above, or costs, that is cost less depreciation less impairment loss, or fair value less cost to sell. A company has acquired a building on 1st April 2019 for 20 lakhs, useful life 10 years. On 1st July 20, the criteria of NCHFS is met and this building is classified as NCHFS. Depreciation 20 divided by 10, that is 2 lakhs per year. On 1st April 20, PPE to 20 to bank 20. On 31st March 20, depreciation to accumulated depreciation to 2 lakhs. Compute carrying value as on 1st July 20. Depreciation is 0.5 lakhs. Depreciation to accumulated depreciation 0.5 lakhs. Carrying value would be 18 minus 0.5, that is 17.5. In case there is no impairment loss, then compute fair value less cost to sell. If the same is 17, then NCHFS would be 17. NCHFS account debit 17. Impairment loss on declassification to NCFHS zero point 0.5 to PPE 17.5. On the reporting date, compute the fair value less cost to sell. On 31st March 21, if the fair value less cost to sell is 16, then impairment loss on declassification would be 1. That is impairment loss on declassification 1 to NCA FHS 1. If on the reporting date the fair value less cost to sell is 18, then reverse the impairment loss to the extent of previously recognized. So the impairment loss is zero point 0.5 earlier, which now it has to be reversed. NCA HFS account debit 0.5 to impairment gain on declassification zero point 0.5. If on the reporting date the fair value less cost to sell is 19, then also reverse the impairment loss previously recognized, that is only zero point 0.5 lakhs. That is NCHFS account debit zero point 0.5 to impairment gain on declassification zero point 0.5. A property is purchased for 5 lakh on 1st April 2013. The useful life is 20 years, zero residual value. The property is measured subsequently at depreciated historical cost. On 30th September 2015, it is decided this property is to be classified as held for sale. Classification criteria met. An impairment assessment on 30th September 2015 determines recoverable value based on value in use to be 4 lakhs. The fair value less cost to sell is 3 lakh 90,000. What is carrying value on 30th September 2015? What is the required amount on classification as held for sale? Answer: 5 lakh. 5 lakh divided by 20, that is 25,000 depreciation. On 1/4/2013, 5 lakh. On 31st March 2015, 25,000. On 31st March 2015, 25,000. Total is 4 lakh 50,000. Less depreciation on 30th September 2015, 12,500. Carrying value as on 30th September 2015 is 437,500. Recoverable value 4 lakh. Impairment loss 37,500. Uh, when we say recoverable value, it is fair value less cost to sell, 4 lakhs. Impairment loss 37,500. Value as per India 16, 4 lakhs. Impairment loss on reclassification to NCHFS 10,000. No. My bad. Recoverable value is 4 lakhs. Impairment loss is 37,500. Value as per India's is 4 lakh. Impairment loss on reclassification to NCHFS is 10,000. NCHFS 3 lakh 90,000. Uh, NCHFS 3 lakh 90,000. Impairment loss on reclassification 10,000 to PPE 4 lakh. Disposal group. Example: following details are given for entity A carrying value as on 31st December 2014. Goodwill 16 million, PPE 28 million, inventory 20 million, financial assets 17 million, financial liabilities 14 million, total value 67 million. Under Ind AS, PPE would be stated at 26 million and the inventory would be stated at 18 million. The fair value less cost to sell of the disposal group is 47 million. Assume the disposal group is classified as held for sale. Show how the disposal group would be accounted in financial statement for the year ended 31st December 2014. So here we look at it. Goodwill, assets liabilities, goodwill 16, PPE 28, inventory 20, financial assets 17, financial liabilities 14, net value 67. Remeasurement 16, goodwill 16, PPE 26, inventory 18, financial assets 17, financial liabilities minus 14, 63 million. Impairment loss minus 16, nil, 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 and minus 16. Fair value less cost to sell nil, 26, 18, 17, minus 14, 47 million. The impairment loss is first allocated to goodwill and then to the other assets in the proportion of the value of the assets. If in the above example the fair value less cost to sell is 40 million, then impairment loss would be allocated to goodwill minus 16 and PPE minus 7. So the fair value less cost to sell is 40 million. In the above example, loss of 7 million is not allocated to inventory, financial assets and financial liabilities as these are monetary items already measured at fair value. Changes in plan for HFS. Building India 16, NCHFS PPE India 16. The company could not sell the assets, hence there was a change in plan. In such a scenario, the carrying value has to be calculated at lower of if such assets have never been classified as held for sale, then the value as on that date, recoverable value on the date of change of plan. Example, a property is purchased for 5 lakhs on 1st January 2011. The useful life of the property is 20 years, zero residual value. The property is measured subsequently on depreciated historical cost on 31st December 2012. It is decided property is classified as held for sale, classification criteria met. On 31st December 2012, the recoverable value is 4 lakhs. The fair value less cost to sell on 31st December 2012 is 3 lakh 90,000. At 31st December 2013, there is a change in plan and the property is no longer meeting the criteria as held for sale. There is no change in useful life of the asset. The recoverable value of as of 31st December 2013 is 385. Show how the property would be accounted in 2012 and 13. Cost as on 1st January 2011, 5 lakh. Less depreciation 2011, 25,000. Less depreciation 2012, 25,000. Carrying value 4 lakh 50,000. Less impairment loss 50,000. Recoverable value as per Ind AS 4 lakh. Less impairment loss as classification of HFS 10,000. Carrying value as on 31st December 2012 as held for sale 3 lakh 90,000. We have to compute the carrying value had it not been classified as held for sale. That it will be value as per Ind AS 16, that is 4 lakh. Depreciation 4 lakh divided by 18, 22,222. Value 4 lakh less depreciation 22,222. Carrying value 3 lakh 77,777. Recoverable value is 3,85,000. Lower of the above two values, 3,77,777 or 385, 3,77,777 would be the value. PPE account debit 3,77,777. Impairment loss on reclassification 12,222 to NCHFS 3,90,000. Discontinued operations. It is a component or segment of CGU which has to be discontinued. Discontinued operation is classified as held for sale when it is sold out. Sun Limited is a retailer of takeaway food like burgers, pizzas. It decides to sell one of the assets in Chandni Chowk in New Delhi. The company will continue to run 200 outlets in New Delhi region. All Ind AS 105 criteria for asset held for sale are met for this outlet in 2016. The outlet will be sold in June 2017. The management believes that the outlet is a discontinued operation and wants to present the results of the outlet as a discontinued operation. The outlet is not a geographical location which has been discontinued. Hence, all outlets of New Delhi region had been sold out, hence it has been closed, then it would have been classified as discontinued operations and held for sale, as it is not line of business or a geographical location which is discontinued. It is not a disposal group. It is important to disclose the results of the discontinued operations separately so that the revenue from discontinued operations could be ascertained. P&L statement for discontinued operations: revenue less expense (PBT), tax (PAT), uh, profit or loss from measurement of HFS of discontinued operations at lower of carrying value or fair value less cost to sell. No difference in Ind AS versus IFRS. An entity can continue to depreciate an asset even if it classifies as NCHFS as per Ind AS 105. The answer to this is false. An asset classified as held for sale must be presented under appropriate asset head with separate disclosure with the note. The answer to this is false. Under Ind AS 105, an entity is committed to distribute the asset to a disposal group must be available for immediate sale in present condition, and distribution must be highly probable. ISPC and HP available for immediate distribution in existing condition, and distribution is virtually certain. Available in immediate distribution, and distribution is reasonably certain. Answer is available for immediate distribution in present condition, and distribution is highly probable. How to measure a non-current asset or disposal group that ceases to be classified as held for sale? Lower of carrying amount which would have been had the asset not been classified as held for sale on the recoverable amount. Answer is A. Lower of carrying amount at the date of asset ceased to be classified as held for sale and recoverable amount. Lower of carrying amount and fair value less cost to sell. Lower of carrying amount which would have been asset not been classified as held for sale. Answer is A. Lower of carrying amount which would have been there had the asset not been classified as held for sale or the recoverable amount. This brings us to the end of the session. Please do like and subscribe the channel and continue to watch the channel on a regular basis. Thank you so much.